Last week, we found out why time decay isn't the enemy. Time moves in one direction at the same speed, so it's 100% known and therefore can't be a risk. Well, if time isn't a risk, what makes an option's price decay? Do options decay over time? Ask any trader what's the biggest risk of an option and they'll give the same response. Time decay. Time decay can't be argued. It's obvious. It's like ice melting, a candle burning, or fog clearing. Time makes them all go away, so why is there any question? You buy an option, time passes, and value leaks out. Theta's the villain, the clock's the enemy. Well, here's the twist. Time didn't just destroy them, time also created them. It took time for the ice to harden, a candle to be created, the fog to form. Time isn't the agent that destroys them. Instead, heat transfer causes ice to melt, combustion causes candles to burn, and warming air causes fog to lift. Time isn't doing the work. It's just the bookkeeping column where changes get recorded. Likewise, the clock on the wall isn't causing options to decay. It just tells you when it happened. But here's another twist. Without time, there would be no decay, because there would also be no options. So there must be something else doing the work that's causing options to lose value. What is it? Options live in information time. What actually happens with time decay is subtler and more informative. Options move through a grid where information and time are intertwined. They work on a grid of information time. So instead of thinking about an option moving through time, think about it revealing information over time too. It's the interaction of information and time that determines whether an option gains or loses value over time. Imagine playing a game where 100 cups are turned upside down on a table and only one has a $100 bill under it. There's a 1 in 100 chance of finding it. So if you had to pay a fee to play, it would be worth $100 divided by 100 cups, or $1. But let's say you turn over one cup and it's empty. It seems like a waste. You spent time and money but got nothing. So the value of the game should fall, right? Wrong. Information was revealed. You still learned something. You learned one cup where the money definitely was not. So even though it seems like the empty cup was a failure, the probability for finding the money has increased to 1 in 99. So the value of the game has increased. If you had to pay to play the game now, it increased to $100 divided by 99 cups, or $1.01. Okay, it's not a big increase, but it's an increase nonetheless. But let's say you turn over 50 cups and still haven't found the money. Time was passing, so it seems like the value should be falling. But now the game is worth $100 divided by 50 cups, or $2. What's causing the value of the game to increase even though you're not finding any money? Yes, time was passing, but more importantly, information was being revealed. However, it's not just any information, it's useful information. The 50 empty cups force the probability of the money to be moved into the remaining 50 cups. Remember, the probability must add up to 100%. So with 50 remaining cups, all of the probability has now been pushed from 100 cups to 50 cups. So even though you may have struck out so far, you're moving closer to the winning cup. That's the role time plays for options. Time is not a catalyst for destroying option value. Instead, it's the catalyst that allows information to be revealed. A lot of information is revealed over time, but it may or may not affect the option's price. While playing the cup game, you may have also learned that Walmart's having a sale on Select Scraps brand cat food, but it has no bearing on the value of the game. Only when valuable information is revealed will the option's price rise. For the cup game, Valuable information is found when each cup is turned over, even if it's empty. They're not valuable themselves, but they reveal valuable information about the future. But let's say time is passing but no helpful information is flowing. Now the option's price decays. For the cup game, this might happen if you had to continue paying a fee but not allowed to turn over cups. Silence isn't neutral. Instead, it's the worst kind of information. Theta isn't time decay, it's information leakage. For options, as time passes, the stock reveals where it may be heading. If it looks like it may be heading in the money, the option's value rises. If the option looks like it's more likely to be out of the money, the option loses value. So it's not that options dislike the passage of time, instead they don't like information to be silent. They don't like time to pass without some type of resolution. Every option position traces a path through information and time. Expiration is not zero time. It's the point where information is fully resolved. Yet traders routinely say, I bought an option, it expired worthless, it decayed to zero. But in the cup game, flipping 50 empty cups wasn't a waste. You have learned something extremely valuable, where the money is not. The option didn't decay from time. Information resolved, just not in your favor. No matter how much you try to convince traders that time doesn't harm an option, the lack of information does, they still can't let go of the idea. They still say, if I buy a call that has $3 of time value, it's going to decay over time. So it's time that's harming the option. It sounds like a good argument, but let's put it to the test in the information time grid. Where did the money go? Let's say you buy a 30-day at-the-money $100 call for $3. That $3 is all time value. So, according to most traders, it's the value of time and will be used up at expiration in 30 days. But now let's say the stock instantly gaps up to $110 and the $100 call is trading at parity or $10. So, where did the $3 go? The stock gapped instantly, so it wasn't lost from the passage of time. If time didn't steal it, where did it go? The $3 was spent on instantaneous information. The second the stock gapped to $110, everyone assumed that this call would become shares of stock at expiration, so there's no reason to pay time value for the right to walk away. You didn't move along the time axis at all. You moved 100% along the information axis. That's why it's wrong to say that options lose value from the passage of time. If they lose value, it's not because of time. It's because no useful information arrived. If the option loses all of its time value instantly, the option didn't decay, it instantly resolved. This is like paying an attorney $500 for a consultation and being told instantly you have no case. Some people look at that as a waste of money. But what really happened was an instantaneous resolution of information. Would you rather have the attorney take 6 months to give the same answer? You may spend time and money to continue trying to build your case, have sleepless nights, and pass up other opportunities that may have had great outcomes had you known the answer. So if anything, the immediate resolution is worth more, not less. Traders, however, relate time to value. Sure, if your housekeeper charged $100 and left immediately, you'd have a right to feel slighted. That's generally true for labor, not for information. Options are tools for uncovering information, and if they resolve it instantly, the bill arrives instantly. That's why the $3 evaporated instantly. Hedging theta is a misperception. Understanding that options live on an information time grid helps to understand why you can't hedge theta. Theta is not a risk factor. It's a coordinate on the grid. When traders say they hedge theta by selling another option, they're really rearranging which information paths they're exposed to. Using the cup game, It would be like selling your rights to flip over cups to someone else. Time is still passing, but you've outsourced the flips. So what happens? If they flip cups, they get the information. Sure, you're protected from paying while waiting, but you're no longer learning anything yourself. You've neutralized the cost of waiting by giving away the right to learn. Hedging theta isn't just about receiving credits. You must consider the potential information you sold. Time and gamma. The cup game also helps to understand gamma. Imagine that you're flipping cups over. You've flipped over 95 cups and still no money is found. But what's happened to the value of the last remaining 5 cups? The value of the game will quickly escalate. That's gamma. It also shows why traders must be careful of using short-term options to collect theta. Those short-term options have a lot of gamma, so you're betting a slow release of valuable information precisely when the most valuable information may be arriving. Theta is usually taught as the amount an option loses per day, all else equal. But all else equal rarely happens. Information doesn't reveal itself in a steady straight line. It reveals it in chunks, like a set of stairs, with earnings, data releases, and other shocks. So a better interpretation is that theta is the price of waiting while uncertainty fails to resolve asymmetrically. Options price this lopsided structure even if traders don't. So, do options decay? Only if you insist on describing unfavorable information resolution using the metaphor of rot. A better framing is this: options monetize unresolved uncertainty, and their value changes as uncertainty resolves across time. Once you adopt this information time grid, time stops being the enemy, and options stop looking like melting ice cubes. They become what they always were: contracts on how and when information reveals itself, and more importantly, how valuable that information is. Options don't decay, uncertainty does. When nothing resolves, nothing was ever lost. Time didn't take value away, it simply failed to deliver any. And when that happens, there was nothing worth learning in the first place. Coming up next week, traders often obsess about win rates. Winning 80% of the time sounds like skill. Winning 30% of the time sounds like failure. It's obvious and dangerously wrong. In markets, a high win rate isn't only unnecessary, it's often a warning sign. Find out why when I cover the myth of high win rates.